We all aspire to grow in life and not remain stagnant. We dream of starting a business or buying a luxurious home, but this requires money, which we often lack. We turn to friends or family for loans. Some refuse, some agree, and others offer help at high interest. We can take loans from banks, but the process is often lengthy. In return of a loan, banks ask for collateral such as property, gold, or other assets. We can then use this money for business growth, buying a home, and other needs. After repaying the installments, the collateral is released by the bank. Banks do not offer loans casually. They assess a person's details, creditworthiness, repayment capacity, and background, largely based on the CIBIL score. A score of 750 or above is considered excellent and reflects a strong repayment history, leading to faster approval and lower interest rates. If the score is very low, such as 300 or 400, loan applications are usually rejected. Even if approved, the loan amount is smaller and the interest rate is higher. This applies to individual borrowers. When a person is unable to repay a loan, they may be declared bankrupt. In such cases, the bank steps in and seizes the collateral property. The bank then announces an auction, sells the property, and recovers the dues, thereby settling the account. Now, I'll share what countries like India, China, Pakistan, the UK, and the USA do in such cases. For example, if India aims to promote growth by building infrastructure such as bridges, cities, roads, trains, flights, rockets, schools, and other facilities, where does the government get money for such development? The first step is within the country by issuing government bonds. For example, if the government plans a rupees 1000 crore bridge project, people can invest in these bonds, which government repays with interest after a fixed period, such as 5 or 10 years. This is how projects like airlines, trains, and bridges are funded by issuing such bonds. In India, this is done by the Reserve Bank of India (RBI). The second way is external borrowing, where a country takes loans from the International Monetary Fund or the World Bank. It may even borrow from other countries like USA, Russia, UAE, China, etc. The International Monetary Fund and World Bank offer large loans to support a country's development. For example, they provide loans of rupees 10,000 crore or 50,000 crore for development projects. The IMF and World Bank do not grant loans casually. They assess a country's creditworthiness, economy, growth, expenses, profits, losses, and overall financial health to ensure it can repay. Loans are provided only when these conditions are in order. When someone applies for a bank loan, it isn't approved immediately. Their CIBIL score is checked. So, does a country also have a CIBIL score? No. Instead, a country's credit rating is assessed by agencies like Moody's and Standard and Poor's. So, before giving any loan, the IMF and World Bank check a country's credit ratings from agencies like Moody's and Standard and Poor's. Now, I'll focus on countries borrowing rather than individuals. As you know, borrowed money must be repaid with interest. When it is used for development for traveling, for example, converting long routes like Mumbai to Delhi, converting into expressways, this improves transport efficiency, boosts the economy, and generates revenue such as tolls, which helps repay loans to institutions like the IMF and World Bank. The economy continues to grow. However, if the economy declines, the IMF and World Bank keep a close watch. Let's take an example. For example, if a country takes a loan of rupees 10,000 crore or even 1 lakh crore, the interest itself can be rupees 100 to 200 crores, which is a large amount. Initially, the first, second, and the third installment are paid. However, the fourth is missed. The country cannot repay the full rupees 200 crore or 100 crore interest. With the IMF, the missed installment raises concern. It is not simply added to the next one. The single default triggers the IMF to review the country and its economy. When a person takes a loan but fails to repay or misses installments, the bank keeps charging penalties and interest, and later the person repays whatever balance remains, such as rupees 4 or 3 lakh. But IMF or World Bank does not work in the same way. They conduct an investigation to assess the country's declining economy. The IMF and World Bank then impose strict conditions such as cutting government expenses, reducing costs on meetings, travel, and other spending to essentials. Savings are prioritized to repay the loan. The officials may shift to cheaper options like trains or metros. Overall, strict, frugal measures are enforced to conserve money. If recovery is not possible, the IMF may provide emergency loans, but only if the country follows strict restructuring conditions. The IMF releases funds in stages and reviews whether the country is meeting agreed reforms before each release. Over time, the country's economy stabilizes and it can repay the loan. This is how the process works. When a person is declared bankrupt, the bank can seize their assets and auction them. A country cannot simply go to the IMF and World Bank and say we are bankrupt. IMF makes efforts to stabilize country's economy and even gives additional loans. The process is more complex and often takes years. Interesting, isn't it? A country with a poor rating does not get loans. If a country fails to repay properly, businesses worldwide may withdraw its investment. This is really a complex and time consuming process. Sri Lanka is a recent example of this scenario. When its economy crashed in 2022, it faced severe shortages of fuel and essential goods. It then approached the IMF and received loan to improve its economy. Another example is Argentina, which has gone through this process multiple times and followed IMF programs to recover. Apart from this, countries also borrow from each other. For example, Pakistan borrowing from China with a repayment plan. Sometimes installments are relaxed or reduced, and such practices are seen worldwide. The process for countries is complex. For example, in India, leaders like PM Narendra Modi or President Draupadi Murmu serve fixed terms during which economic performance is assessed. The IMF also review why an economy is weak or growing. The process is strict, lengthy, and involves very large amounts. This was unique information shared to improve your general knowledge. It's interesting. Do share it.